Have you ever wondered why stock prices sometimes seem to defy logic? One day, a company's stock soars despite no apparent change in its fundamentals. The next, it plummets on a minor news story. What's really driving these wild swings? The answer might surprise you. It's not just about numbers and charts. It's about human psychology. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Today, we're diving deep into the fascinating world of market psychology and its profound impact on stock prices. While many investors focus solely on financial statements and economic data, they're missing a crucial piece of the puzzle: the human factor. Stock markets are often portrayed as rational systems where prices move based on earnings, revenue, and economic indicators. While these fundamentals undoubtedly matter, they only tell part of the story. Investor behavior, shaped by emotions, biases, and group psychology, plays an equally powerful role in determining stock prices. Understanding market psychology helps explain why stock prices sometimes deviate significantly from their intrinsic values, and why phenomena like bubbles or panics occur. Without grasping this human element, investors risk misinterpreting market movements and making costly mistakes. Let's start by examining the two most influential emotions in investing: fear and greed. These powerful forces drive market cycles and can lead to extreme price movements. Greed propels investors to chase rising prices, fueling bull markets and sometimes inflating speculative bubbles. On the flip side, fear triggers panic selling, accelerating bear markets and market crashes. History provides us with vivid examples of these emotional cycles. Remember the dot-com bubble of the late 1990s? Greed and excitement over new internet technologies pushed tech stock valuations to astronomical levels, far beyond what their fundamentals could justify. Similarly, the housing bubble leading up to 2008 was driven by a collective belief that real estate prices could only go up. But what goes up must come down. The 2008 financial crisis and the more recent COVID-19 market crash in 2020 demonstrate how fear can trigger massive sell-offs, often pushing prices well below their fair values. These cycles are less about rational analysis and more about collective emotional responses to uncertainty and perceived risk. Investor sentiment, the overall mood of the market, plays a crucial role in shaping these trends. When optimism dominates, prices tend to rise as more buyers enter the market, confident in future gains. Conversely, when pessimism sets in, markets decline, even if the underlying fundamentals remain relatively unchanged. It's important to recognize the role that media outlets, social media platforms, and financial news channels play in amplifying these emotions. Positive headlines can fuel rallies, while constant negative coverage can worsen downturns. This creates a feedback loop between sentiment and media that can exaggerate market swings, sometimes even creating self-fulfilling prophecies. Another fascinating aspect of market psychology is herd behavior. As social creatures, humans have a natural tendency to follow the crowd. In financial markets, this often manifests as investors piling into popular stocks or sectors because they believe the group must have superior knowledge, or simply because they fear missing out. A phenomenon known as FOMO, while following trends, can sometimes generate short-term gains. It often leads to the formation of bubbles that eventually burst, leaving late investors holding the bag. We've seen this play out recently with meme stock rallies and cryptocurrency surges, where prices are driven less by underlying value and more by collective excitement and social media hype. Overconfidence compounds these issues. Many investors overestimate their ability to predict market movements, leading to excessive risk-taking. This behavior fuels speculative frenzies and can result in painful losses when reality finally sets in. Beyond these broader emotional trends, individual psychological biases shape investor decisions in subtle but powerful ways. Take loss aversion, for instance. People tend to fear losses more than they value equivalent gains. In investing, this can cause traders to hold on to losing stocks for too long, hoping for a rebound or sell winners too early to lock in profits. Confirmation bias is another common pitfall. Investors often seek out information that supports their existing beliefs while ignoring evidence to the contrary. This can reinforce poor investment decisions and prevent investors from objectively assessing new information. Anchoring is yet another bias to watch out for. Investors frequently fixate on arbitrary reference points, such as a stock's previous high price, and base their decisions around them, even when circumstances have fundamentally changed. These cognitive biases distort rational decision-making and create inefficiencies in the market that savvy investors can potentially exploit. It's crucial to understand that stock prices are not only a reflection of corporate performance, they are also mirrors of human psychology. Professional investors and analysts recognize this, which is why many use sentiment indicators, like the VIX, often called the Fear Index, investor surveys, or social media sentiment analysis, to gauge market mood. By combining fundamental analysis with psychological insights, investors can make more balanced decisions. A purely numbers-driven approach misses the emotional dynamics that often drive short-term volatility and can lead to missed opportunities or unnecessary losses. So, what's the key takeaway for investors looking to navigate these psychologically driven markets? First and foremost, awareness of your own emotions and biases is just as important as analyzing financial statements. Successful investing requires discipline, staying rational when others panic, and remaining cautious when others are overly optimistic. Remember, in the short run, markets are heavily influenced by psychology. Fear, greed, and collective sentiment can cause significant price swings. However, in the long run, fundamentals such as earnings growth and economic conditions tend to dominate. This is why many successful investors advocate for a long-term perspective, which allows you to ride out short-term emotional volatility. By using psychology as a tool rather than letting it control your decisions, you can gain a significant advantage in the market. Stay aware of market sentiment, but don't let it dictate your entire strategy. Develop a solid investment plan based on your goals and risk tolerance, and stick to it even when emotions run high. Understanding market psychology doesn't mean you can predict every market move, but it does give you a valuable framework for interpreting market behavior and making more informed decisions. By combining this psychological insight with solid fundamental analysis, you'll be better equipped to navigate the complex world of stock investing. Remember, the most successful investors are those who can harness the power of both logic and emotion, using their understanding of market psychology to stay one step ahead of the crowd. So, the next time you see a stock price moving in ways that don't seem to make sense, take a step back and consider the psychological factors at play. You might just gain a whole new perspective on the market. Thank you for joining us today on the Savvy Finance Corner. We hope this exploration of market psychology has given you valuable insights to enhance your investing journey. Remember, wealth begins with knowledge, and understanding the human side of the market is a crucial step towards financial success. Until next time, stay savvy and invest wisely.